Yes, please.
Yeah, I actually had a more clarification than question. Dr. Cao, when you did your work, how reliant were you on the 7A data? Was that a central data set, or was that a piece of the data set?
So we actually use the public release of the 7A data from the SBA. So the public use version of the data that is available from the Small Business Administration. Yep.
So on the originations, were they mostly 7A credits?
Yes, I think in the data set they separate the 7A program versus I think the other one, which is the 504 program.
So I think you're asking for the main test. I think main test was CRA data.
Yes,
CRA data. It wasn't. So to me, the 7A is such a narrow, and I'll ask the same question of Dr. Wang in a minute. The 7A data is quite narrow, and it is a very specific application of expertise, and many community banks don't have the scale to do SBA lending, therefore a lot of the conclusions are there. The similar question for Christina. The PPP data, could you run your analysis and exempt the PPP and run it with the PPP? The PPP gave a really good view of access of borrowers to the banking system, but it was completely non-underwritten. And so it has as I'm trying to think about the conclusions I would have, it doesn't necessarily indicate to me the benefit of the technology interface, because it was such an unusual structure. And when you see the great dip of the green, that's all PPP, isn't it? The government lending, is that?
A couple of pieces to answer your question. So first of all the analysis done for the pre-pandemic years, that has nothing to do with PPP. And I completely agree with you. PPP is very different from the standard or typical credit lending in the sense that there's no credit risk whatsoever in making the loan, right? And so in fact, if you think about it, that actually gave these technology lenders an advantage because they're very fast. But they're not necessarily better at processing whether it's a good credit or bad credit, because oftentimes they didn't have the information. But in that circumstance, it didn't matter to them. They bore none of the credit risk. And their technology advantage actually came to the fore, right? And then the other thing about what's shown on that chart, sorry, I had to kind of rush a little bit. So because the PPP had no credit implication whatsoever for the lender, and so there's no lien associated with any of them. So none of the PPP loans is actually in the data. So you saw that big increase in government lender during the COVID period. Those were actually the so-called EIDL loans.
Okay. So, and then Dr. Yu, it seems to me the application, and I haven't seen it yet, with these big data sets, we at the local level as a bank would have the prospect of running our banking data against a central file or understanding. So we could do a lot more receivable lending, as an example, at a low level where small banks, it's hard to do cash flow lending, but there could be models that come out of AI based on what you're saying that would allow that. And in the UK, that I could see the big models running against each other, where you said, okay, I can just look at my customer's checking account data, they have to have all of it with me, and create a model where I could be more expansive in the lending that we did. So.
Yeah, but I think the key difference between the US and the UK is that in the UK, there's no official way or a verified way to get a bank statement like the US. So they can, small business, they can always fake the bank statement, or they can just choose the bank statement because if they have 3 bank accounts, they may always choose the favorite one and give that to the bank. But they maybe can hide other bank statement, right? But under for banking, all bank transaction data will be shared.
Just to follow up on that idea with AR lending, borrowing-based lending, and we're a cannabis bank, so we have to do a lot of monitoring. We have to go to the point of sale of each cannabis business on a daily basis to see the transactions. And I can see how this can work with a non-cannabis AR, where if we have permission to share their transaction data, match it up with the bank's data on their deposit transactions, I can see a nice how that would work in an open banking system where we give some information up, but we're also receiving information from a point of sale tied to our vendors' financial statements with their AR and inventory lines and all that. And now the problem creates is that I have all this data, how do I monitor it? Well, I'll have an AI engine that can go through this data, take out the duplicates, look for the fraud where someone may be cooking their books a little bit, and see how that works together. So I think all that works together well.
James Johnson, Iowa Division of Banking. Just a kind of a question or observation. When you talk about distance lending to small businesses, is there a concern that that would create kind of a cherry pick scenario where you have people that are looking at the data and where you're not using the soft data, you're not willing to bet on some of those other individuals, so you just pick the prime candidates, and you could actually reduce credit availability to some people in that case where you essentially would pick a winner or a loser. When you look at the community banking model, it's based upon everyone in that community being a winner. That's what their bet is. In the distance model, you're looking at selecting who you're going to choose as the winner. Is there a concern that there could actually be long-term a detrimental impact from more distance? And is there a way then that we could get the local institutions to have more access to the information, that hard data, more effectively to help the small businesses generate that data for them so they could do that locally where they want all winners?
Go ahead.
Oh, yes, I really thank you for your question. I think there are a couple of aspects of AI. I think, based on all the papers that we discussed today, I think soft information is still really important. But as you guys can see, in the anecdotal example I showed you, I think AI has a capability of, streamline a lot of, the manual work so that, the loan officers can dedicate more time and more resources and energy to collecting those soft information. So which means that, they could be helpful for the community banking model where I think soft information is really valuable. I think another question for the hard information collection. So there are some data that might be available or hard information that is available at these small business borrowers, but it's just that they are not in machine readable format. So AI can help the bankers to convert them into machine readable format and to use them in the decision making process. So I do see that AI has both roles in terms of saving more time for soft information assimilation and also collecting more hard information.
Yeah, and I would say for the cherry picking, argument, I think that what Jeff's results show is the benchmark is no loans, right? So you do one more loan, and maybe that is a cherry picked loan, but it's better than the alternative. So I think the danger would come if the conclusion you draw is let's just do distant lending. AI allows us to do that, and then you get rid of local lending. That's the danger. But I think that's separate from his benchmark is people are underserved, we give them one more loan, but you don't want to go that far for sure.
Right, yeah, I think that's my fear, is that it becomes a replacement instead of a supplement too.
Right.
And a solution is how do we help more banks get into those communities that are underserved as opposed to trying to serve them from more remote locations.
Yeah, a different way to interpret his results would be, if you have local banks, you don't need the AI loans.
Just to clarify, I think our main dependent variable is the loan growth in that county. So basically, we are comparing how many loans for that county compared to the previous year. So, thank you very much.
Hi. One of my concerns about the prevalence of internet lending is we haven't really seen that space go through a downturn where all of a sudden the information they're getting from Plaid doesn't fully support their continuation of being in a community. And yet, in the meantime, because people have moved to internet lending, the community financial institutions have potentially moved out of the community but now you don't have someone who's actually invested in the community. They don't, I'm the commissioner of Montana, the space up near Canada, there's like 8 people, I guess. But if they go online and get a loan, and then during a downturn, there needs to be, you need to have lenders who care not just about the bottom line and the net interest margin, but also about the continuation of a community for lending purposes, that maybe have an emotional connection there, not just a financial one. So that is one of my concerns about the prevalence of the online lenders.
If you don't mind, can you expand on what does that mean? Because I'm going to use as an example mortgages. You can imagine who's the largest mortgage lender in the country?
Rocket.
Mm-hmm. Okay.
Yeah.
Would you consider that community or internet?
Internet. And I always like to shout out that the state system comes together in order to supervise companies like Rocket and do multi-state supervision and examination of them. I think Rocket it's a challenge, because I think Rocket and some of those online lenders can certainly provide lower cost competitive options at times, but then they're going to have, and we watched during the last financial crisis, those online lenders have a really challenging time working with all of the borrowers in order to get them into programs that might support them not losing their home, very differently than if you are working with a local lender. Some of it is the servicing side, which unfortunately the capital rules have made it difficult for community banks to continue to service mortgages. But there is a disconnect, I think, between where people are getting loans today and the feelings they have about their community. And I don't think they understand the long-term impacts of the decision that they're making on small rural communities,
right.
Their own home.
And to your point, the graph I shared was really trying to really distill that. The reality is we're seeing that happen right before us. And I just use Rocket as one example, but we're seeing in private credit on the commercial side. And so I think having these discussions allows us to think about where we need to regulate properly and what is our long-term intention in terms of what we want the system to be. But to your point, I fundamentally agree with the basis of your question.
Yeah, good guy from Detroit, huh?
Yeah, so one more question, please.
Morgan Mastriani. I'm a PhD student at Purdue. So this was brought up by a few of the panelists. Big banks are typically earlier adopters of new technology. I'll use AI as an example. And small community banks, in comparison, may be a little bit behind the curve there. So a seemingly intuitive conclusion to me is that smaller banks might be more reluctant or less likely to approve a loan to a local business that's looking to adopt new AI technologies. And maybe this is a barrier to community development, especially in rural communities. So my question for the entire panel is, can you come up with a counterexample to this? Under what conditions would that local business that needs a loan in order to adopt this new technology be just as likely or more likely to get that loan from their local community bank rather than another source of funding, whether it's an internet-based provider or a larger national bank? Thank you.
Don't mind, Kenneth, why don't you take first crack at that one since you're a community banker?
That one's kind of challenging, because when I think about what you're asking, it makes me think of a new entity kind of in the technology space, and so I'll try to answer it from that perspective. The capital stack and how you fund that looks very different than what we call traditional banking. And so you're talking about potentially seed money, round one, venture, mezzanine, into the process of becoming bankable, unless they really have a product that really demonstrates that they can turn over and create revenue generation. and then that's different. So a bank like ours would look at it. And what Tong was sharing was, even if you're in software, if you've got a demonstrated ability to have, what was the term you used instead of fixed assets? It was another term you used, I'm sorry. Floating, yes, floating. And so you could lend off of those accounts receivables or that revenue that is coming in a way to do that. I just don't know a better way to try to explain that question. I think hypothetically what you're asking is, if the community banking space is behind technologically, are they naturally endowed to be supportive of companies that are technologically endowed or desire to be? And I think that shows up in where we find technology spurting, right? You look at Silicon Valley, it's known for that for a reason. You look at places like Detroit or Boston, they are known for that for a reason. They create ecosystems where there are individuals of like-mindedness who try to leverage their ability to do things that are innovative and creative. And so for us as a hard asset lender, that's just a space we wouldn't play in. I'm just trying to answer your question. We wouldn't play in that space if someone had an idea to try to do that, just because of the way that we bank. And that's just the way we've defined our business model.
It strikes me that large banks aren't making those loans either, though. It's different types of funding.
It
is, right.
Can I just jump in very quickly? I think I think Ken has already covered the sort of tech forward startup situation. It's just a different stack of funding, different type of funding. I think what's more relevant for the vast majority of small business is about how to apply AI technology in their daily operation. They're still producing their same products, right? It's just now they have to make a decision regarding, do I turn to some sort of agentic service provider as opposed to hiring another worker or reallocating the tasks to my existing employees. And my sense is that given the nature of the technology, none of the small businesses would have the capability to actually do any internal investment in terms of, actually building a model or anything of that nature. It's more about they're going to buy the services from a service provider. And so their decision is regarding, is it more cost effective for me to have an employee and do that work versus buying that service? Or how do I integrate my employees' sort of capabilities and augment it by the purchase services? And as I think about sort of any lenders, because they still need to get credit somewhere. So in terms of how that would imply in terms of the matching with which type of lender, in my mind, it's actually more an issue about whether the lender has a good grasp of the technology and which type of, say, agentic model would help which type of business and how to integrate with your existing employees. And if the lender has a good grasp of that type of information and how that model will work, I think that lender would have an advantage in terms of being able to support and identifying that kind of promising business going forward.
All right, and with that, if you'll join me in thanking John, Jeff, Christina, Tong, and Kenneth